Welcome to your custom deep dive. You wanted to understand financial statement analysis better and sent over a resource that breaks the process down into 6 steps.
Okay.
So we'll unpack each step today, going beyond textbook definitions to uncover some real-world insights.
Cool. I think what makes financial statement analysis so captivating is it's like piecing together a puzzle.
Okay.
Each number, each ratio tells a piece of the story, and our job is to figure out the bigger picture.
That's a great analogy.
Yeah.
It's not just about crunching numbers, it's about understanding the narrative behind them.
Right.
The resource we're diving into today starts by emphasizing the importance of understanding the industry landscape before we even glance at a company's financials.
Yeah.
I'm curious, why is that initial step so crucial?
Well, imagine trying to analyze a company without understanding the competitive forces it faces.
Okay.
It'd be like trying to judge a fish by its ability to climb a tree. Each industry has unique characteristics that shape a company's profitability, growth, and even the risks it faces.
So it's about understanding the playing field before we assess the players.
Exactly.
The resource mentions Porter's 5 forces as a framework for analyzing these industry dynamics.
Mm-hmm.
But instead of a generic overview, let's get specific.
Okay.
Say we're looking at the electric vehicle industry, a hot topic right now.
For sure.
How would we apply Porter's 5 forces there?
Let's focus on the bargaining power of buyers, one of the 5 forces.
Okay.
In the early days of EVs, buyers had limited choices.
Right.
But now, with more players entering the market, from established automakers to startups, buyers have a lot more options.
Yeah, for sure.
This increased bargaining power puts pressure on EV companies to lower prices, offer better features, or even provide incentives.
Gotcha.
All of which can impact profitability.
So even if an EV company has impressive technology, if they don't navigate this shift in buyer power,
Yeah.
their financials might not reflect their true potential.
Exactly. Understanding these industry dynamics helps us interpret the numbers in a much more meaningful way. Beyond competitive forces, we also need to consider things like regulations, technological advancements, and even social trends.
Right.
All of which shape the industry landscape.
Okay, so once we've scoped out the industry, the next step, according to the resource, is to identify company strategies.
Right.
This seems pretty intuitive.
Yeah.
Companies within the same industry can choose very different paths, right?
Absolutely. And that's where strategic choices become critical.
Okay.
Think about 2 companies in the same industry. Maybe a high-end fashion designer and a fast fashion retailer.
Right.
The first might prioritize exclusivity and high profit margins, focusing on a smaller, wealthier customer base.
Right.
The second might go for volume, offering trendy, affordable items to a broader market.
Gotcha.
Mm-hmm.
So even though they're selling clothes, their financial profiles are going to look drastically different
Right.
because their strategic choices dictate how they make money.
Exactly. This difference in strategy will be reflected in their financial statements. The luxury brand will likely have higher gross margins, reflecting those premium prices, while the fast fashion retailer will have lower margins, but potentially much higher sales volume and inventory turnover.
It's fascinating how understanding these strategic choices adds another layer of insight to the numbers.
Yeah,
It's like knowing the company's playbook before we analyze the game film.
that's a great way to put it. We also need to consider how integrated a company is within the value chain.
Okay.
Do they handle everything from manufacturing to distribution, or do they outsource certain functions? Each decision impacts their cost structure and overall profitability.
The strategic analysis also helps us understand a company's approach to diversification.
Mm-hmm.
Some companies focus on a single product or market, betting everything on that one horse.
Right.
Others spread their bets across multiple industries or geographies.
And that diversification choice influences their risk profile.
Right.
A highly diversified company might have more stable earnings, riding out industry-specific ups and downs. But they might also have lower growth potential compared to a company that's all in on a high growth, but potentially riskier market.
Okay, so we've analyzed the industry, we've assessed the company's strategy,
Yeah.
and now we finally get to the heart of the matter. The financial statements themselves.
Right.
But step 3 warns us that not all financial statements are created equal.
Mm-hmm.
I'm curious, what makes some statements more reliable than others?
It all boils down to the quality of the information presented.
Okay.
Financial statements are based on accounting rules and principles, but there's still room for interpretation, for judgment calls.
Yeah.
What we're looking for is how accurately those statements reflect the underlying economic reality of the business.
So we can't just take the numbers at face value.
Right.
We need to understand the accounting choices behind those numbers.
Exactly. We need to be aware of the potential for bias,
Okay.
for what's called earnings management, where companies might manipulate their reported earnings to make things look rosier than they actually are.
Can you give me an example?
Sure.
How could a company, say, manipulate their earnings to make their profits look better?
One way is through revenue recognition, which we touched upon earlier.
Right.
Let's say a software company closes a big deal in December.
Okay.
Instead of recognizing the revenue when the contract is signed, they might delay recognizing it until January, boosting their earnings in the new year.
Oh, wow.
Or they might stuff the channel pushing products onto distributors even if there's no real demand, just to inflate their sales figures.
So understanding these potential accounting tricks helps us read between the lines.
Yeah.
And avoid being fooled by superficial numbers.
Right.
It's almost like becoming a financial detective.
That's a great way to think about it. We need to scrutinize the details.
Mm-hmm.
Look for inconsistencies and question assumptions.
Okay.
And one of the trickiest areas, even for seasoned analysts, is dealing with intangible assets.
Intangible assets, those things like patents and trademarks
Yeah.
that are valuable but hard to put a precise dollar value on, right?
You're right.
Our resource specifically mentioned that self-developed patents often aren't capitalized as assets on the balance sheet.
Mm-hmm.
Why is that?
It comes down to the difficulty of reliably measuring their value.
Gotcha.
Sure, a company might have a groundbreaking patent,
Right.
but until they license it or sell it, it's hard to say exactly what it's worth.
Okay.
So, under accounting rules, companies often can't record these internally developed intangible assets at their estimated fair value.
That's so interesting.
Yeah.
It means a company that's heavily investing in R&D might actually appear less valuable on paper than a company that's not innovating as much, but has more tangible assets.
Exactly. And this highlights one of the limitations of financial statements.
Okay.
They're not always perfect reflections of a company's true economic worth.
Right.
They're representations based on rules and estimates, which means we need to be critical thinkers, not just number crunchers.
This is definitely making me rethink how I approach financial information.
Yeah.
It's not just about the numbers themselves, but about understanding the nuances, the judgments behind those numbers.
Right.
That's a whole new way of seeing things.
And that shifting perspective is key to becoming a savvy financial analyst.
Yeah.
Once we've assessed the quality of the financial statements, we can move on to the analytical phase, where we start using tools to really understand a company's performance.
Sounds like we're finally getting to the fun part. I'm ready to crunch some numbers and see what these financial statements can reveal.
Let's dive in. We have a lot of ground to cover, but we're going to equip you with the tools to analyze any financial statement with confidence.
I can't wait. But before we get lost in the numbers, let's take a quick break.
Okay.
And then we'll come back and tackle the next 3 steps in our financial analysis journey. Stay tuned.
Sounds good. Hashtag TTS, the deep dive episode 2024-12-19, part 2 of 3.
All right, we're back, ready to dive into the analytical phase of financial statement analysis.
Okay.
Our source lays out 3 powerful tools: common size statements, percentage change statements, and those all-important financial ratios.
Right.
Let's start with common size statements.
Okay.
Those sound pretty self-explanatory.
They are. Common size statements express each line item as a percentage of a common base.
Gotcha.
For example, on a common size income statement, every item is shown as a percentage of total revenue.
Okay.
This makes it easy to compare companies of different sizes or to track a company's performance over time.
So instead of looking at raw dollar amounts,
Yeah.
which can be hard to compare across companies or years,
Right.
we're looking at proportions and trends.
Exactly. Let's say we're comparing 2 retailers, one with $1 billion in revenue and another with $100 million.
Okay.
By looking at their common size income statements, we can see how much each company spends on things like cost of goods sold, marketing, or administrative expenses as a percentage of their revenue.
Gotcha.
This helps us understand their cost structures and profitability in a much more standardized way.
That makes sense. It's like leveling the playing field, so we're not just comparing apples and oranges.
There.
What about percentage change statements?
Okay.
Those seem pretty straightforward, too.
They are. Percentage change statements simply show the percentage change in each line item from one period to the next.
Right.
This highlights areas of growth or decline within a company.
So a company's revenue grew by 10% year over year, but their cost of goods sold increased by 15%, that would raise a red flag.
Yeah.
Their profitability might be shrinking, even though their top line is growing.
You're catching on quickly. Percentage change statements are great for spotting these trends and understanding the dynamics behind the numbers.
Okay, now for the heavy hitters. Financial ratios.
Right.
I remember these from my finance classes.
Yeah.
But let's be honest, they can be a bit overwhelming.
Sure.
There are so many different ratios. How do we know which ones to focus on?
It's true. There's a whole universe of financial ratios out there.
Yeah.
But the key is to choose ratios that are relevant to the specific analysis you're doing.
Okay. And to interpret them in the context of the company's industries, strategy, and overall financial health.
Our resource mentions two common ratios, EPS, or earnings per share,
Right.
and ROE, or return on equity.
Okay.
Let's start with EPS.
Sure.
It's basically how much profit a company made for each share of its stock, right?
Exactly. EPS is a widely used metric for evaluating a company's earnings power.
Okay.
But it's important to remember that EPS can be influenced by various factors,
Yeah.
including a company's capital structure and accounting choices.
Right.
So we can't just blindly compare EPS across different companies.
Right. Context is key. What about ROE?
Okay.
That one always seemed a bit more complex to me.
ROE, or return on equity,
Yeah.
measures how effectively a company is using its shareholders' investments to generate profits.
Okay.
It's a key indicator of management effectiveness.
So a high ROE suggests that management is doing a good job of creating value for shareholders.
Right.
But a low ROE might signal that they're not using those investments as efficiently as they could be. Exactly. But again, we need to consider industry benchmarks and historical trends.
Yeah.
A high ROE in a slow growth industry might be more impressive than a high ROE in a booming industry.
It's all about relative performance and understanding the bigger picture.
For sure.
Our resource doesn't go into detail on other specific ratios.
Yeah.
But it mentions that they can be grouped into several categories.
Right.
Can you give us a quick rundown of those key categories?
Sure. We have profitability ratios,
Okay.
which we've already touched upon with EPS and ROE. These ratios measure a company's ability to generate profits from its operations.
Right.
Think of metrics like gross profit margin, operating profit margin, and net profit margin.
Okay.
They all tell us something about how efficiently a company turns revenue into profit.
Then there are liquidity ratios, which I remember as being all about a company's ability to pay its short-term bills.
Exactly. Key liquidity ratios include the current ratio and the quick ratio, which measure a company's ability to cover its short-term liabilities with its readily available assets.
Okay.
Think of it as a company's financial cushion, its ability to weather short-term storms.
So if a company has a low current ratio,
Yeah.
that might be a warning sign that they're struggling to keep up with their short-term obligations.
It could be. It's definitely a red flag worth investigating further.
Okay.
We also have solvency ratios, which focus on a company's long-term financial health and its ability to manage its debt load.
Ah, yes, solvency. That's all about making sure a company isn't drowning in debt, right?
Precisely. Important solvency ratios include the debt-to-equity ratio,
Okay.
which measures the proportion of a company's financing that comes from debt versus equity.
Right.
And the times interest earned ratio, which tells us how well a company's earnings can cover its interest expense.
So a high debt-to-equity ratio might indicate that a company is relying too heavily on debt financing,
Right.
which could make it vulnerable if interest rates rise or its earnings decline.
Exactly. It's all about finding the right balance between debt and equity financing.
Gotcha.
We also have activity ratios,
Okay.
which sometimes go by the name efficiency ratios.
Right.
They tell us how effectively a company is using its assets.
So, for example, inventory turnover would measure how quickly a company is selling its inventory.
Yeah.
And receivables turnover would tell us how quickly they're collecting cash from their customers.
Exactly. These ratios give us insights into a company's operational efficiency. Are they managing their inventory well? Are they collecting payments promptly?
It sounds like these activity ratios are all about making sure a company's assets aren't just sitting idle,
Right.
but are actually working for them.
You got it. And finally, we have valuation ratios, which relate a company's market value to its financial performance.
Okay.
We've already mentioned the price to earnings PE ratio,
Yeah.
which compares a company's stock price to its earnings per share.
So a high PE ratio might indicate that investors are optimistic about a company's future growth prospects, while a low PE ratio could suggest that they're more pessimistic,
Yeah.
or that the company is undervalued.
That's a common interpretation, but it's important to consider other factors as well.
Right.
industry norms, and the company's risk profile.
Right. No single ratio tells the whole story.
Yeah.
We need to look at the full picture, combining these quantitative metrics with our qualitative assessments.
Absolutely. Financial ratios are powerful tools, but they're just tools. They need to be interpreted with context and judgment.
Okay, so we've analyzed the past, we've crunched the numbers, and now, according to our source, it's time to put on our forecasting hats and look ahead to the future.
Right.
Step 5 is all about preparing forecasted financial statements.
Okay.
This sounds like the part where things get a bit more speculative, a bit more uncertain.
It does involve some educated guesswork.
Yeah.
But it's not about pulling numbers out of a hat. We're using all the knowledge we've gained about the industry, the company's strategy, and its historical performance to make informed projections about its future financials.
Our resource emphasizes that the accuracy of any valuation we do later on hinges on these forecasts.
Yeah.
So no pressure. Right.
You got it.
Yeah.
But it underscores the importance of building a robust model based on sound assumptions.
Okay.
When forecasting financial statements, we consider factors like expected revenue growth, potential cost changes, and the need for future investments or capital expenditures.
So let's say we're forecasting the financials for a fast-growing tech company. We'd need to think about how quickly they can realistically scale their revenue.
All right.
Whether they'll need to ramp up their spending to support that growth.
Yeah.
And what kind of impact that will have on their profitability.
Exactly. We'd also need to consider things like competition, technological advancements, and regulatory changes, all of which could impact their future performance.
It sounds like forecasting is a delicate balancing act, weighing historical trends against potential future disruptions.
Right.
How do we ensure that our forecasts are realistic and not just pie-in-the-sky projections?
One important technique is sensitivity analysis, where we test how changes in key assumptions impact the forecast.
Gotcha.
For example, what if revenue growth is 5% lower than we projected?
Right.
Or what if the cost of raw materials spikes unexpectedly?
Okay.
By running these scenarios, we can get a sense of the range of potential outcomes and assess the downside risks.
So it's about building in a margin of safety.
Yeah.
Recognizing that the future is inherently uncertain.
Precisely. Another technique is scenario planning, where we develop multiple forecasts based on different possible futures.
Right.
We might have a base case scenario, which is our most likely projection, an optimistic scenario, and a pessimistic scenario.
Gotcha.
This helps us understand the full spectrum of possibilities and make more informed decisions.
It's fascinating how forecasting combines both quantitative analysis and qualitative judgment.
For sure.
We're using data and models, but we're also factoring in our understanding of the industry and the company's strategic direction.
It's a blend of art and science,
Yeah.
which is what makes financial analysis so challenging and rewarding.
I'm starting to see how all the pieces of the puzzle fit together, how each step builds upon the previous one,
Right.
leading us towards a deeper understanding of the company's story.
And now, with our forecasted financials in hand,
Yes.
we're finally ready to tackle the ultimate goal, valuing the firm.
This is the moment of truth, where we assign an actual dollar value to the company.
Right.
It feels like we've been building towards this point throughout our entire analysis.
It is the culmination of our journey. Valuation is the process of determining what a company is worth.
Okay.
Taking into account all the information we've gathered, the industry dynamics, the company's strategy, its financial performance, its growth prospects, and even our assessment of the risks it faces.
Our source mentions several approaches to valuation: dividends, earnings, cash flows, and market comparisons.
Okay.
Can you give us a quick overview of each method?
Let's start with the dividend discount model, or DDM.
Okay.
This method values a company based on the present value of its future dividend payments.
Gotcha.
It's like saying, if I buy this stock, how much income will I receive from its dividends over time?
So it's similar to how we value a bond based on its future interest payments.
Exactly. The DDM is most applicable to mature, stable companies that pay consistent dividends.
Okay.
We discount those future dividend payments back to their present value,
Right.
using a discount rate that reflects the riskiness of those payments.
What about the earnings-based approach?
Okay.
That one seems pretty intuitive.
It is. This approach values a company based on its earnings or net income.
Okay.
One common earnings-based valuation method is the price-to-earnings PE ratio,
Yeah.
which we talked about earlier. It compares a company's stock price to its earnings per share.
So a high PE ratio might suggest that investors are willing to pay a premium for each dollar of earnings.
Right.
while a low PE ratio might indicate that they're not as optimistic about the company's future prospects.
That's one interpretation, but we always need to consider context. PE ratios vary widely across industries,
Right.
and we need to compare a company's PE to its peers and to its historical average to get a sense of whether it's overvalued or undervalued.
Then we have the cash flow-based approach,
Okay.
which I remember as being a bit more complex,
Yeah.
but also more robust.
It is considered a more fundamental valuation method because it focuses on cash flows,
Right.
which are less susceptible to accounting manipulation than earnings.
Gotcha.
One popular cash flow-based method is the discounted cash flow DCF analysis.
That's the one where we project a company's future cash flows
Yeah,
and then discount them back to their present value, right?
exactly. The DCF analysis is a powerful tool for valuing companies that are not yet profitable
Okay.
or that have significant growth potential because it looks beyond current earnings to the company's ability to generate cash in the future.
And finally, we have market comparisons,
Right.
which seem like a more relative approach to valuation.
They are. With market comparisons, we're looking at how a company's valuation stacks up against similar companies that are publicly traded.
Okay.
We might look at metrics like PE ratios, price to book, PB ratios, and price to sales, PS ratios, to see how the company's valuation compares to its peers.
So if a company is trading at a lower PE ratio than its competitors,
Yeah,
that could be a sign that it's undervalued by the market.
it could be. But again, we need to consider the reasons behind that discrepancy.
Right.
Maybe the company has higher risk or lower growth potential than its peers,
Yeah.
which would justify a lower valuation.
It all comes back to context and critical thinking.
Right.
We're not just plugging numbers into formulas. We're using these valuation methods as frameworks for making informed judgments about a company's worth.
You've got it. Valuation is both an art and a science. We're using data and models, but we're also relying on our experience, our judgment, and our understanding of the company's story.
This deep dive has been an incredible journey, taking us from the broad industry landscape
Yeah.
to the intricate details of financial statements,
Right.
and ultimately to the hub evaluation.
Mm-hmm.
I feel like I've gained a whole new toolkit for understanding and evaluating companies.
And that toolkit will serve you well as you continue to explore the world of finance,
Yeah.
whether you're an investor, an entrepreneur, or simply someone who wants to make sense of the financial news.
I'm definitely feeling more confident in my ability to approach financial information,
Yeah.
to ask the right questions,
Mm-hmm.
and to look beyond the headlines to the real story behind the numbers.
That's the spirit. And remember, financial analysis is a continuous learning process.
Yeah.
The more you practice, the more you'll refine your skills and develop your own intuition.
I can't wait to put these skills to use. But before we wrap up this deep dive, let's take a moment to reflect on some key takeaways and leave our listener with some final thoughts. Stay tuned for our concluding insights.
Sounds good. Hashtag TTS, the deep dive episode 2024-12-19, part 3 of 3.
We've covered a lot of ground in our deep dive into financial statement analysis.
We have.
We've gone from understanding the big picture of industry dynamics to the nitty-gritty of financial ratios and valuation methods.
It's been quite the journey, but you know what's most important to remember?
What's that?
Financial statement analysis is more than just a set of technical skills. It's a way of thinking, a framework for understanding the language of business.
So it's more about the way we think about it than anything else.
Exactly. It's about piecing together the clues, connecting the dots,
Okay.
and ultimately uncovering the story that those numbers tell.
So as our listener embarks on their own financial analysis adventures, what are some key takeaways they should keep in mind?
First and foremost, always remember that context is king. Never analyze a company's financials in a vacuum.
Okay.
Consider the industry, the competitive landscape, the company's strategic choices, and even the broader macroeconomic environment.
It's like trying to interpret a single brushstroke without seeing the entire painting.
Yeah,
You might miss the bigger picture.
precisely.
Yes.
And second, don't be afraid to be skeptical. Remember that financial statements are based on accounting rules and estimates, which means there's always room for interpretation and even manipulation.
We've talked about earnings management and the potential for bias.
Right.
It's crucial to maintain a healthy dose of skepticism and to look beyond the surface.
Absolutely. And third, focus on trends and patterns over time. Don't just look at a single snapshot.
Okay.
Analyze how the company's financials have evolved over the past few years and try to understand the underlying drivers of those changes.
That's where those percentage change statements and trend analyses become so valuable.
Exactly. They help us see the trajectory, the direction the company is heading in. And finally, remember that financial statement analysis is a continuous learning process. The business world is constantly changing, and new accounting standards, industry trends, and economic factors emerge all the time.
So it's not just about one and done. You have to keep learning all the time.
Right. It's not about memorizing formulas or becoming a walking encyclopedia of ratios. It's about developing a curious mind, a critical eye, and a thirst for knowledge.
Well, nice.
Financial statement analysis is a journey, not a destination. The more you explore, the more you'll discover.
Right.
And the more confident you'll become in navigating the complex world of finance.
Well said. This deep dive has certainly given me a newfound appreciation for the power of financial analysis. I used to feel intimidated by those dense reports, but now I see them as puzzles waiting to be solved.
Yeah.
Stories waiting to be uncovered.
And that's the beauty of it. It's a challenge, but it's also an opportunity to understand the forces that shape businesses, industries, and even the global economy.
So really, it's about understanding the entire world.
Right. Exactly.
Well, I think we've equipped our listener with a solid foundation in financial statement analysis. They're ready to put on their detective hats and start deciphering those financial statements.
I think so. And who knows, maybe they'll even uncover a hidden gem or two along the way.
The possibilities are endless.
They are.
Thanks for joining us on this deep dive, and we look forward to exploring new knowledge frontiers with you in our next episode.
See you then.
Until then, happy analyzing.